Better. All right, Gold Team, we are really excited to have our guest with us today. Mary actually was kind enough to figure this out to connect us with Jeff, which was great. So Jeff is with Capital Advisory Group. He's actually an author of a book, Keeping What's Yours. And we thought, actually, Neil Costello, we were having our weekly get together, and Neil said, boy, it'd be great if we had somebody on that could talk about what we do as agents and what we can keep. And so Jeff, thanks for joining us today. I know you're a busy man this time of year, so welcome.
Thank you.
Group.
Thanks for having me.
Next time for the heck of it.
I'm not.
Study of the circle, what fun. And he said, yeah, it looks good. I look fat.
I'm not going to move my camera because you
want a Zoom meeting. It's okay.
All the stuff over here. So the stacks of tax returns sitting out there. But big picture, we're basically an accounting firm, financial planning firm. Also, we tie the two together. They go hand in hand. So some of the stuff I'll kind of say tax-wise,
right?
And then go back off to the other stuff.
Hold on a second. Okay. Mute. Okay, there we go. Got you, Jeff. Okay.
Okay.
Sorry about that.
So big picture, the environment that you guys are in, you guys are, I'm sure, all 1099, employees basically. So the tax side of it is your baby. The biggest thing that the takeaway I will give to you today that is the biggest thing is document, document, document. And I say that it sounds elementary. The issue that we're going to run into, probably not for 2023, but I pretty much can guarantee you 24 going forward, is you have a target on your back. You are a small business owner, and all politics aside, no matter what you hear, you will be basically grilled over the next couple of years with the IRS enforcement. Reason being is you're self-employed. IRS says you cheat on your taxes every year, and they're going to be looking for an extra couple $100 from everybody as we go forward. So the biggest thing is document, document, document. The easy pickings one is your mileage. So if you guys try to keep a digital app, so there's Mile IQ, keep it and keep it up to date as you go forward, seriously. Because when they do show up for an audit, they're going to ding you, and the IRS requires that your mileage has to be in ledger format, and it has to be in a date format. You just can't say, hey, I've got 500 miles, and go with it. They're not going to go with it. They're going to say, hey, where'd you go? Who'd you see? So there's an app out there. There's many apps out there. The app that we like a lot, and I can get the email over to you. You get I think it's a 20% discount if you guys buy it. I don't make anything for it, but we just use it enough. It's called Mile IQ. But I get you an email. It's got a little saver code on it. It's like 45 or $50 a year. You get 20% off. It literally will record everywhere you go, what you do, and all you do is left swipe it for personal, right swipe it for business. At the end of the month, it'll give you a run of everything. It's in Excel format, so you could produce it. You'll never show the Mile IQ app to an IRS agent. You would just print it and hand them the actual detail of it. So, but it'll track your total miles, business miles, everything. So.
That's a big tip, Jeff. So really what it does is it just tracks you, and then your miles are already in there, and then you can print it out.
Yeah, it's Big Brother watching, so don't panic on that though, because like I said, you will never turn this app over to anyone. You will print an Excel spreadsheet that shows your mileage, and it's somewhat intuitive. So once it sees, like when you drive to the office, or if you drive back home, or you go to a certain client, you go to lunch with somebody consistently, it will pick that up, and it knows where you're going. It knows it's business. It automatically clocks it for you. So that's going to be the first thing in your industry that they're going to go after, is proper recording of mileage. So, and then I'll kind of step back and do, from a commissionable standpoint, there's kind of 3 different avenues that you guys could go down. First one is going to be basically sole proprietor. You don't do anything. You don't create any companies or anything, just at the end of the year, your 1099 shows up, you clock it on your personal return. But the key to that is when you do that under a Schedule C, self-employment tax is huge, okay? So, and I'll back up for a minute. If you guys ever had a job, got a W-2, out of your income, you paid 6.2% to Social Security and 1.45% to Medicare. And then the employer matched that dollar for dollar. But if you are a Schedule C, you're paying 15.3% in self-employment tax plus federal tax plus state tax. So it gets kind of expensive. So if you ever do your estimates and you get to the end of the year and you're like, wow, I blew that one, I owe way more than what I thought I did, it's because of self-employment tax, okay? So the next kind of entity is an LLC. And so that's a limited liability corporation. But if you are a single member LLC, it's going to default back to a Schedule C anyway, and you still owe the self-employment tax. What the LLC does is it gives you an extra layer of legal protection. That's it. Other than that, it runs and looks identically to a Schedule C. But if you create an LLC and it's husband and wife, you guys then have to file what's called a partnership return, which makes it a little bit more complex, which is a 1065. And then I'll say the mother of all is what's called an S corp, which basically is a corporation, and it's nothing fancy. It's an LLC, could actually be an S corp. All you do is go to the IRS and say, I would like to be taxed as an S corporation, which means it's a pass-through and it comes over and hits all the profits or losses come over and hit your personal return. The S corp though has two elements. The first element is what they reference as reasonable compensation. And it says basically you should take a paycheck for some of your income or your profits. The other part of it is owner's distribution. So it's a draw that comes across to hit your personal return. The draw is not subject to self-employment tax, okay? So the setup is, yes, you still have to pay the hypothetical self-employment tax on the W-2 income that you take. So let's say that you got a $100,000 profit at the end of the year. $50,000 would be paid to you through a W-2. You'd pay your taxes just like normal through that. The other $50,000 is an owner's distribution. That $50,000 comes across and it is not subject to the 15.3% self-employment tax. So you could save a ton of money just right there. And again, the S corp gets a little bit more complex. You got some reporting you have to do to the federal agencies and state agencies, but that's kind of your big picture as you go forward. So I don't know if that confuses anybody.
No, Jeff, I wanted to ask you a question about that because you laid out three different things, and obviously, everybody's got their own personal things about what they would want to do and how they want to be set up. If you were an agent going in today, starting new, how would you set yourself up?
I would start as an LLC because of the income, the revenue in a sense. And as you built up the revenue, maybe when you get to the high 80s, over 100,000 of revenue, switch and go to an S corp. And the reason being is that profit, the 15.3% in the self-employment tax, you don't pay it for the owner's distribution. So IRS will let you go about 50-50. So 50% in W-2 income, 50% in owner's distribution. So you're saving that 15.3 as you go forward.
Neil, you got your hand up?
Same liability protection on an S corp as an LLC.
Yes, so it's got the veil of the corporate protection in a sense, so that if they tried to penetrate that, they're only going to get what's inside the corporation. So you write a check, liquidate it, and say, "Here's a company. Have a nice day." They can't come after your personal assets, though.
Are there any downsides to the S?
The only downside to the S is it has to file its own tax return, so it's actually filing a true corporate tax return, but it's in the S format. So you have your payroll withholding issues as you go. I say issues is probably a bad word. You have to do a 940 and a 941 at the end of the year. So every quarter, as you take money out, even if you don't take a check, you got to file a 940, which if you don't take a check, you put a 0 on it and send it in. If you take a check, they're just double checking to make sure that you pay your payroll taxes as you go forward. So that's the biggest complexities of it as you go forward. So, and then like in your case, I guess, big picture for you guys, some of the stuff to be aware of. So I guess to your clients too, is this year for 2022, they took away all charitable contributions. So you don't get it unless you can itemize it. So there's no non-itemization of charitable contribution. One of the big things though is PMI. In 2021, you could write it off if you itemized. It made less than like 100 grand married and 50,000 single. They disallowed that for 2022. So the primary mortgage insurance, you can't deduct it anymore. One of the other things for you guys is client entertainment. And I say this openly, client entertainment in the past, you could write it off. In today's environment, if you buy somebody baseball tickets, you cannot write off those baseball tickets. Now, if you take them to the baseball game and you sit with them and buy a beer, hot dog, you can write off all the food and drink that you want, but the actual tickets cannot be written off. So one of the examples is when the senior golf tournament came in last summer, somebody bought a $50,000 tent. The tent is not deductible, but all the food and beer that they gave out to everybody was. So just kind of one of those things. Everybody thinks, oh, I buy season tickets to the soccer. I'll hand it out to my clients. You can't do that. That's not deductible. It's a non-deductible item out there. So it's client entertainment versus food and beverage. So, and then a client gift. So here's one where you kind of got to be careful on. Literally, the IRS says that if you give a client a gift, it's $25 max that you can deduct. But if somehow you could, I say finagle that to where you could say it's marketing, then you could write off the full amount. And I say that seriously. So whatever you do technically, and this is where the only way that you'll ever really get caught on this stuff is when you get audited. And then they rip your tax return apart and find all this stuff, and then they're just knocking stuff out left and right. So is anybody got questions on that stuff?
So
Yeah, Mary.
if they give a client gift and they put marketing material in the basket with the client gift,
It's marketing.
so then you can write off the whole thing. You can write off the whole thing.
Exactly. Other than if you bought a gift certificate or something of that effect, you're stuck at $25. And that's the true IRS guidelines for client gifts. But as long as it has some marketing element along with it, then it's advertisement.
Yeah, we've got a vendor partner that's cut from 80. They put the name like
It's personalized.
Yeah, the Roberts team, and then they personalize that cutting board or whatever.
Right.
Yeah.
Yeah, perfect. And then basically, so from a marketing aspect, everything that you guys do, business cards, letterhead, office in the home. So if you guys don't pay rent for an office, I say at the main location, and you guys office out of the home, you get to take that deduction too. And an office in the home is basically you take the total square footage of your house, find the biggest room in your house that you can use. Don't try and use your basement because that's a little too carried away. But the example would be, say your house is 1,000 square foot and you have an office that's 10 by 10, it's 100 square feet. It's 10% of the actual true house. What you can do then is you get to take a deduction for office in the home, which is all your utilities. Any repairs to the house. So say you put a new roof on it, 30 grand, you get 10% of that, or $3,000 that you get to deduct. You buy a screen door for $100, you get $10, it goes against that. The trick to it is you do not depreciate the actual house. So that's another element that could be brought in where you depreciate the value of the house. Don't do it. because if you go to sell it at a later date, there's a depreciation recapture, and then you end up owing a little bit of tax. But on a standard office in the home, you're taking real estate, if you don't itemize, you're taking your real estate tax, you're taking your mortgage interest, your any homeowners associations that you pay, and dropping all that stuff in on office in the home, and it's completely legit. So a lot of people panic and say, "Oh, I don't want to do that," and then again, depending upon how you file your tax return, you could do, like if you bought a computer, if you bought a desk. So a desk is a direct expense on that office in the home. You're taking a deduction. Anything around the house is an indirect deduction, so you're getting a percent of it. Artwork in your office is deductible. Paper, pencil, all kinds of fun stuff like that. Software, if you guys got to buy software, that's all deductible. So that's a little perk by office in the home. A lot of people pass up. They're like, "Oh, I don't want to mess with that," but it's completely legit. As long as you don't pay rent to where you actually rent a building, then under that concept, you can't take the office in the home. Even though everybody today in today's environment works from home, it's one of those things the IRS just hasn't given a blessing on yet, on being able to pay rent somewhere and still work from home. All right, boring everybody.
No, it's good
Taking
information.
it in.
The other thing is,
You stunned everybody, Jeff. You stunned everybody. Everybody's in awe right now, buddy. To include
yeah,
myself.
I have that effect on people. So the other side of the equation, one of the bigger things is estimated payments. So anybody that is a Schedule C, as you go forward, estimated payments are huge. And really IRS is starting to crack down on this. In the past, they kind of let some of this stuff slide. They didn't really impose penalties, but what you will see in today's environment is if you do not pay at least your previous year's tax liability in to the system, now there's a couple of nuances that you need to know. They will turn around and they will hit you for a failure to pay proper estimated payments, and they will charge you interest on top of the tax that you owe. And again, if you file an extension, the extension is strictly to do the paperwork. You still got to pay all the taxes by April 15th, or if you're an S Corp or a partnership, your returns due today. So that's the only other nuance to a S Corp is it's 30 days early. So you do the S Corp first and then do your personal behind that. But again, so your estimated payments are April, June, September, and January 15th of every year. And the key to it is if you don't know how profitable you will be for the year, go back to last year, just take what your total tax liability was, but carve off just strictly for your business. So if you have a spouse that works and they're W-2'd, it's kind of a slur with your tax return. They're offsetting a lot of the tax that's actually due. So what you do is figure out what your tax is and just pay it 4 times a year. You're safe. If you owe the IRS more than IRS and the state more than $1,000, they're going to hit you for underpayment penalties. In the past, we always played the game saying, "Hey, time value of money," which means if I owe the IRS $2,000, I'm not going to get real worried about it, and I'll pay it when my tax return is due. But here's the issue: that was in the past when the interest rate that they charged you per quarter was like 1.2%. It was nothing. In today's environment, the quarterly interest rate for taxes due is 5.5% per quarter. So if you had to add up over a year, that's a chunk of change. So they hit you hard for that. And then if you underpay your estimated payments, they add another little failure to pay the proper estimated payments for an underpayment penalty on top of that. So at the end of the year, the actual penalties and the interest can be a chunk of money, which just at the end of the day, just make sure you pay it. But if a spouse works and they're W-2 and they're paying into the system, that's going to help offset some of the taxes that you owe. So that's something to definitely keep in mind. Flip of that is IRAs, SEPs, and what's called a unit K, 401k. So these are all items that you could do help to reduce you're basically paying yourself first. So IRA, everybody's familiar with that. It's a deductible IRA. Depending upon your age, it's either $6,000, or if you're over 50, it's $7,000 with the catch-up. And literally what that's going to do is that it's going to actually reduce. So if you had $10,000 of taxable income and you did a $6,000 IRA, it's just going to reduce the taxable income by $6,000. Won't take tax away by no means. But instead of paying the IRS, you're going to pay yourself first as you go forward. So IRA is simple. There's a Roth IRA, but really doesn't give you any tax benefit. That's the polar opposite of a traditional IRA. A Roth is after tax, grows tax deferred. You never pay tax on it again, but it's not helping you in today's environment to reduce your taxes today. Then there's what's called the SEP, which is a Simplified Employee Pension Program. And there's nothing simple about it. If you're an actual owner / employee of your own company, you're regulated to 20% of your profits. But if you're an employee of a company, it's 25% of the profits that could be maxed up to 60. I think this year's rule is 66,000. So the SEP literally will give you the ability, if you have $100,000 profit, you can put 20 grand away. You then pay tax on 80,000 as you go forward. They could be invested in anything, and you guys being real estate agents, believe it or not, with the right trustee, you can actually use your IRA to go buy property with. I mean, actual, rental property. You got to be super careful because the way the IRS states the rule on this is you couldn't as much as buy a light bulb to put into the property. Otherwise, it's a contribution. And you go through all kinds of Mickey Mouse stuff. But if you have the right trustee and enough money in it, you could go buy rental property all day long. We see that all the time, especially if you know what you're doing in the real estate arena. The average Joe stepping in, I'd say don't ever do it. You'll screw it up basically, but you guys would understand that. So, and then the third thing to do is what's called a Unit K 401k. This is a real life 401k, no different than the outside world. The beauty of this is as long as you do not have employees, you can actually do this and you could defer, depending upon your age, it's $22,500 today. So that's pre-tax dollars. That's your contribution in the sense of $22,500. And if you're over 50, you get to do 30 grand this year. That's pre-tax dollars going in. On top of that, at the end of the day, if you have a profit company-wise, you will able to do an additional 20% of your profit. So you could go all the way as high as almost $68,000 within this unit K. And then you get to pick where it's invested. You could park it in, the bank, you could put it in the market, you could do whatever you want to do with it. So those are the three differences. It's basically the gauge. You can't do combinations of them. And I say that only from the standpoint, if you do a traditional IRA, you're regulated to that, say, $7,000. And then the problem is you can't say, hey, I'm going to do an IRA at 7 grand, then I'm going to go jump into a unit K and do 20. It's you're maxed out as you go forward. So you could do a unit K. You could do 3,500 in a unit K and 3,500 into a traditional IRA. That's that $7,000 threshold. So now you could have an IRA sitting out there, but not contribute to it and then still be able to do this unit K. So it goes by contributions on an annual basis. So those are the three big things out there. Take advantage of them. It'll help you dramatically. And then, the kind of the bigger picture is if you have an S Corp, health insurance wise, I don't know if you guys buy your own health insurance. If you do, there's a way through the S Corp that it's called a Section 125. So the average person will pay for health insurance, self-employed. But at the end of the day, the trick will be is that you really don't get the full deduction for it. You're going to take your premiums and you're going to take that as a business expense. But all your co-pays and, all the office visits, pharmaceutical, all that stuff, you get nothing for it. You're trying to pile that up to get 7.5% of your adjusted gross income. Honestly, most people will never make it. So if you create what's called a Section 125, it's a pre-tax setup for your health insurance. So literally your premiums, your deductibles, your co-pays, pharmacy, everything is contained within one little unit. And at the end of the year, you get to take 100% deduction against business income for all of those expenses. So the 125 is kind of a cool thing for people self-employed. That's from a company called Task. And I think it's a $400 annual fee for them to set this stuff up for you, but it saves a ton of money. I mean, a ton of money. So I babbled a bunch, so I'll open anybody got any questions?
Is that the only way to get that section 125 is through that company?
Yeah, it's got to be a third party because the IRS will put all these crazy limitations on you. And this third party will actually keep those, they'll make sure that you abide by all of these requirements, if you want to call it that. So to give you an idea, I have health insurance, unfortunately, through Obamacare and ACA in my name, but it's my wife's employee benefit program, if you want to call it that. So even though it's in my name, it's her employee benefit program. And we go from there. And so I take premiums, I take co-pays, pharmacy, everything. And at the end of the year, I get this huge 1099. I get to take a deduction for the full amount. And I got to give Task, I think it's $400 or $450 a year for their administrative services. And they're the ones, though, that keep tabs on all of this stuff that we spend on an annual basis. So.
Interesting, I didn't know that. Yeah, it's a whole different deal. Yeah, Joe.
Hey, Jeff. So how about utilities on your home? Are those deductible at all if your office is in your home?
Yes. So in the office in the home, it's a percent of whatever the total square footage of your house, and then the square footage of what you deem your office. So like I said, pick the biggest room in your house and say that's your office. Just if the IRS ever shows up, drag your desk in there and make it look like you're working from there. But then you take all your MSD, you name it, whoever you pay out, and you get, so if it's 10%, you get 10% of all your utilities. And again, what most people overlook are we see it where they double dip too. And you got to be careful on this. If you itemize, you can't take your mortgage interest and you can't take your real estate tax because that would be on a Schedule A. But if you do not itemize, if you can't make that threshold of the itemization, then you get to take that on the office and the home deduction and you get a percent of it too. So does that help?
Okay.
Yeah.
Thank you.
And it's everything. So the other thing I see is don't put your internet as a utility. It's actually a business expense. So you get to take, instead of taking a percent of it, take it and put it the internet as a true business expense as you go forward. And going down that path, if you have internet and you really work hard from home, take 60% of it. Don't take 100% of your internet. And the reason I say that is if you get audited, you want to leave a little bit to the side that you could actually bring back in at a later date. And two, the IRS knows that you don't walk away from working and never touch your internet at home. So some of it's going to be personal use too. So that's why I say that 50, 60%, we see people that go, hey, my internet bill for charter is $1,200 a month or $1,200 a year. And they try to write that off. If you get audited, they'll eat that stuff up in a heartbeat. So take whatever your fee is, the same with your cell phone bill. And this is from experience. Don't just plop your cell phone bill on your tax return and say, hey, it's it. Take, depending upon how much you use it. If you have one that's strictly business only, 100%. If you have one that's personal and business, 60-ish, 50-ish, depending upon how much you text other people, you call other people. But be careful on that because that's something else they'll sneak up on you. And that's not fun when they come along and say, hey, you said you had, and this is the stupid stuff that they're gonna be digging in our tax returns looking for. But that's $100 here, $200 there, and at the end of the day, it's a $500 bill you owe them, you know, and that's what they're looking for. The other side of the equation is for you guys, and again, IRS, it's what's called Section 179. Section 179 originally was designed in the tax law for equipment and machinery. So if you're a contractor, you got to buy a $500,000 Caterpillar. You don't want to try and depreciate that thing over 15 years. You're going to take it and write it off in 1 year. So if you guys buy vehicles and you guys could, I mean, you're showing houses, you have to have the appearance for your clients. So if you guys buy, I say high-end SUVs, and I say SUVs because it has to have a vehicle weight of 6,001 pounds or greater. You can literally take your entire, you buy an Escalade, it's 120 grand. You could take the Escalade and write it off in 1 year. So if you, and so it's only up to whatever your business income is, but you could write it off in 1 year and not have to depreciate it. So if you ever look at this, it's a way, you just have to say your vehicle is used 100% for business purposes, which is true. But you could justify it because you're going to have clients that are going to jump in with you. You're going to drive them around. You have to have that appearance, you know, so it's anything that's 6,001 pounds. Trucks qualify, high-end SUVs. Typically, most luxury sports cars do not, unfortunately. They won't make the cut. They're under that 6,000 pound limit. And if you do that, you're taking bonus depreciation. So if you bought a new Lexus, BMW, the problem is you're going to have to take that over a 5-year period in a sense to depreciate it versus if you buy a high-end SUV. A lot of the mid-size SUVs qualify too. You're taking 100% deduction straight out. So.
Question, Jeff, would you happen to have like a little, a little checklist on, like you said, these items could be, deductible or anything like that, you know, us agents are very benign at understanding this whole environment. That's why we go to accounts, say, here's our shoebox, here's our receipts.
No shoebox is allowed, no shoebox.
But if you happen to have like a little check, that'd be great. Maybe send it over to Brent.
Yeah.
And maybe we could possibly share it, but personally, Jeff, so I mean, you bring up a lot of good insight on, understanding, guys, that remember we keep talking that you guys are running a business. You're not just real estate agents. Well, this is another component on why you guys need to understand you guys are running a business because of Jeff's information that's been provided to you. That's a lot of stuff to think about, guys, and a lot of stuff that we're probably missing out because we just don't know.
Exactly. And again, I say you don't know what you don't know, and there's nothing wrong with that. It's the fact of when you guys are running businesses, and again, I say this, and I really push the issue. Anybody that's in the small business arena, all politics aside, but you really have a target on your back in the next couple of years. IRS is supposed to hire 87,000 new agents. And everybody's like, oh man, they're going to be chasing us galore. It's not the 87,000 agents we're worried about. It's the 5,000 revenue agents that they actually hire. The rest are going to be clerical. They'll help us get stuff done. If you have a problem right now, you call the IRS. Good luck is all I can say. We have a preparer's hotline. 9 out of 10 times, we can't even get through if we have a technical question. But when they hire these people and put them in play, there's going to be an element that are revenue agents, and they'll be assigned to all the service centers across the country. And they're going to come out with a vengeance because their income is going to be dependent upon what revenue they can raise. And you say, wow, I mean, that's the reality of it. For what the federal government spent in the last 6 years, 5 years, it's a huge chunk of change that somebody needs to pay for it. And we're going to be the ones doing it, unfortunately. So, Any other questions?
Oh, other than the fact that you just told us that these guys are gonna be revenue, commission based on revenue, that's great.
Pretty much.
That's just great.
Unfortunately, now again, to hire 87,000 people is gonna take them a bit. And the problem is they're, right now, all they're doing is the IRS is matching person to person. So the people that are retiring, they're able to match and just keep the head count the same. But they'll get to a point here over the next couple of years, once everybody really comes out of the woods from COVID, where people will show back up and say, hey, I want to work. And then that's when we have the issues going down the path. So as long as you're, like I said, as long as you got your documents set, good to go, you should be fine. You know, but somebody, if you go, I don't know, I'm just going to make this number up. For mileage, we see that all the time where we call, and I know for a fact they're guessing. And again, for 2022, if you haven't filed your return yet, you need it from January 1st to June 30th. And from July 1st to December 31st are two different sets of mileage. So if you do that, if you do your return yourself or you turn it into somebody, they're going to come back and say, hey, what was your first half of the year mileage? I think it was 59.5 cents. And the second half of the year, it's like 63.5 or something like that. But on the tax return, it's actually broken down in first 6 months, second 6 months from a mileage standpoint. So,
Anybody else have any questions?
Everybody's asleep, that's why.
Jeff, we really appreciate you taking the time. And I know we joked about this before you got on, but I do know it's a really busy time of year for you. Taking time out to meet. And for those who want to hear more about this, Jeff is an author of the book, Keeping What's Yours.
Yes.
And he's on 550 KTRS at 3 o'clock on Saturdays.
Every Saturday. Yep, every Saturday I put everybody to sleep. So tired, just listening, and you'll be
$3 o'clock
Jeff,
on
can I ask
Saturday?
a question for you, please? And obviously, this is probably an important one for our agents, especially some that perhaps don't have a CPA firm that represents them on a frequent basis. Maybe they kind of use, they file their own, and maybe they use a bookkeeper, or maybe they use an accountant this year, and then next year they don't have something consistent. Are you accepting new clients at this very moment? Are you too busy to accept new clients, or?
No, we're taking on new clients. So if you just want to call, as the later we get into the year, the way that we'll kind of do it, because I'd love to sit down and talk with you, but the time won't be there. So if you could drop everything off, and I need previous year's tax return to see what you had going, any credits, anything carry forward, and then your stuff for this year. Not to say that once I look at a tax return, I pretty much know what I need, or somebody could reach out to you and say, hey, to deduct this, we need all this stuff. So if you guys want, if you get it over here, that's awesome. We also have it's a digital vault. So the tax world is pretty much still, ledger sheets and stupid stuff like that. But in today's environment, we have a digital vault. So we send you guys a link. You guys upload everything in a PDF format. You don't even have to move from your house. We have everything sitting here. When we're done, we can put a preview for you out there. You could look through it, critique it. Even if you didn't want to come sign anything, we will do you guys are familiar with DocuSign, super simple, one spot, you sign it, we e-file the return. And then as soon as we get past the deadline this year is April 18th, as soon as we get past April 18th, then we'd love to sit down with you, walk you through and say, hey, this is what you did in 22. Here's what you need to do for 23. Here's the stuff that can help you. Here's what's hurting you, and go from there.
That's great, Jeff. I want to make sure if anybody wants to email Jeff, it's jeff@capitaladvisory, it's grp.com.
Yes.
We're also going to send an email out to you guys with his contact information, so you guys have it in case you'd like to maybe consider using the service, which highly recommend. I mean, Jeff just taught me in the last 10 minutes more stuff than I hate to even throw it out there, but never mind. I won't bad talk anybody. I'm going to stay quiet. But
Or
Jeff,
anything.
thank you. We really appreciate it, guys. You guys got some insight information here that honestly, it tells you again, the significance of having someone that understands what they're doing with your guys' taxes and information, because, you know, we always bad talk the IRS, but hey, if you know whether there is benefits and someone knows how to use those benefits on your behalf, then hey, you got the right person, right?
As long as you stay within the guardrails, you're safe. If you get
That's
off,
it, yeah.
that's where the issues kick in. So,
Yeah,
And Jeff, I just want to make sure your telephone number is right. 636-394-5524. Is that correct?
yes, that's it. That's it.
yeah, we'll share it all to you guys on email. We'll do a blanket email to the whole, all our agents to include these. Yes, Kay, you have a question?
Is there a particular software program or something that you recommend to keep track of expenses and stuff? I mean, I know you gave us the mileage link, but is there some other, you know, like QuickBooks or something that you recommend?
QuickBooks is one. It's just, the problem is QuickBooks, you used to be able to buy a desktop version that you could put on your desktop at home. You buy it one time, you have it forever. Our friends at Intuit, which is, they rule the world in the accounting software, have kind of gotten away from that. You got to do QuickBooks online, and they charge you a monthly fee, but you could do like, I think it's a $20 or $22 monthly fee. But it's a little tricky on uploading stuff. But Quicken, which is, I think it's $55 a year to buy it, is probably another one that you could, that's desktop based. It's not, you know, online based. But between the two of those, that would be more than enough. And at least we see stuff that comes in on QuickBooks and on Quicken that's kind of, it's there, but it's not really all there. But we can help kind of massage that for you at the end of the year to make sure that it's right. Because QuickBooks, you got to do your reconciliations and you got to do all kinds of stuff with it to make it function correctly. Quicken might be even better. So, yeah. That is very true.
Yeah, it's Chris said I sit in a spreadsheet, it's magic.
Yes. So we kind of
Yeah,
take
Chris
that
is saying-
and use what we need to use and move forward. So,
Yeah, I just send him a spreadsheet and he does
yes.
whatever he does. I don't know.
Oh, Chrissy, you use Jeff?
We do.
Oh, that's awesome. Cool.
Yeah.
So, well, there you go. How about giving us a little insight on your, you know, how you feel about using Jeff, man? Maybe that also gives them an insight from our end.
We love him. He's all, well, like I said, I send him a spreadsheet that probably doesn't make any sense, but they figure it out and then he asks for a couple things, get it over to him, and it's pretty quick and painless. I mean, except for paying taxes.
Yeah, that's no fun, believe me.
No. And he
Okay,
also
fine.
saves me money because I opened the is it a SIP or SE? I don't know what it is.
Yes, the set.
Yes, every year. So then I pay into it, but it costs me less money to pay taxes.
Exactly.
Yeah, I love it. Wow, that's good stuff, guys. Chrissy, thank you for your insight. I appreciate that. Anybody else have any questions for the man? I know he's busy, so we want to make sure we value his time and respect it. We're all good? All right,
Thanks, everybody.
guys, go ahead.
I was just gonna say, Jeff, and thank you so much for making the time too.
Thanks, guys. Thank you.